Feast your eyes on a 7.6% dividend yield. This is NUSI, and I'm going to be explaining what it's all about right now. And as an added bonus, I actually want to compare it against JEPI, because JEPI is very similar. They're both very high dividend yielding ETFs that focus on having a lower beta than the general market, so less volatility. So I think that's going to make for a really awesome comparison, so let's dive right into it. All right, so this is the investment strategy overview of NUSI. Step 1, purchases all underlying stocks in the NASDAQ 100 index. Okay, so it follows the NASDAQ. Coolio. Step 2, deploys a rules-based options collar strategy. I will explain that momentarily. Step 3, distributes monthly income from options, premiums, and equity dividends. Step 4, additional premium may be used to reinvest in the underlying portfolio of the NASDAQ 100 stocks. Okay, so it does some reinvesting, and that's where a lot of the capital appreciation comes from. So what is this step 2? What is an options collar strategy? Well, it's very simple, and I want to compare it against QYLD because these are very similar ETFs, believe it or not. NUSI just takes it one step further, which is something that a lot of people are actually going to like. So QYLD is everyone's favorite 11% dividend yielding ETF. It sells at the money call options every month, month after month. It collects those premiums and pays them as distributions, and it's not designed for capital gains at all. Because the call options are at the money, that leaves no room for capital growth. It's focusing 100% on the highest premiums and distributions as possible. All the price appreciation you see when you look at the graph is simply from reinvesting some of the premiums. So that's what QYLD is all about. You have limited upside potential and you have unlimited downside potential because of the nature of call options. NUSI takes it one step further. So yes, they have call options with the premiums. They generate the income in the same exact way, but they have downside protection in the form of put options. And that's why the dividend yield is 7.6% versus 11.4% in QYLD, because they take some of the premiums from the call options and they use that to buy put options as downside protection. And here's a little visual visualizing what that's all about. And they aim to operate in this range of plus or minus 10 to 15% in a month. So that's how much it's going to move maximum in a month. Any more than that, and the options get called and it limits your upside potential. And if the market dips any more than that, the put options kick in and protect you from the downside. So hopefully that explains a little bit of how it's similar to QYLD with the added downside protection and how it kind of operates within that narrow range of plus or minus 15% month after month. And also, much like QYLD, it does take some of the premiums to reinvest in itself to generate some more price appreciation. But like I said in the beginning of this video, I actually want to compare NUSI versus JEPI. So it's very similar to QYLD in all the ways I just explained, but when you look at it versus JEPI, we can see JEPI has a dividend yield of 7.5%. NUSI has a dividend yield of around the same exact percentage. As mentioned, NUSI has downside protection, and JEPI focuses on having less volatility, so in a way, less downside potential. So on the surface, they're very comparable ETFs, but underneath the surface, they're actually quite drastically different in the way that they operate. And this difference is why we see a very drastic difference in the charts of both these ETFs. So orange is JEPI, and this purple is NUSI. And we can see that NUSI is doing what it's supposed to do. It's operating within that very shallow range. And JEPI has much more price appreciation while they both have a very similar dividend. And you're looking at the total return right now. If you want to split that into just price, this is what that looks like. So the first main difference is JEPI isn't based off the NASDAQ 100 index like NUSI and QYLD. In fact, it's not based off of any index. It simply is trying to be benchmarked against the SP 500 over the long term, and it's trying to have comparable total returns. So that's a big difference right there. The next one is 80% of this ETF is held in large cap dividend stocks. So that's just regular equities. 80% of this ETF is just equities. And that's going to give you much more upside potential because with NUSI, you're stuck in that 10 to 15% range up and down. So when the market's red hot, like it has been for the past few months, JEPI is going to have much more upside potential. And then to generate that extra income, 20% of this ETF is what's called equity-linked notes. So these are debt instruments linked to the underlying equity holdings in this ETF, or 20% of the underlying equity holdings. Now, to better understand what ELNs really are, here's an article that I pulled a lot of information from, and I'm just going to read a few sections that are relevant to what I'm talking about. So right here, first, underline the fact that ELNs is a debt instrument, i.e. something resembling a bond, but in the case of ELNs, they are based on a single stock, a basket of stocks, or an equity index. While they may contain equities, they resemble bonds because they protect an investor's principal and offer coupons for ongoing income. And when they reach maturity, they pay the holder at least 100% of the amount invested. If the stock or equities in the note are worth more at maturity than when they were purchased, the investor receives a portion of the difference as well. So right there, this is how JEPI has downside protection, much like NUSI. They do it much differently through ELNs, which are indeed more complicated than just put options, I have to say. But if you believe in the management of JEPI, which is JP Morgan Chase, then this ETF also offers pretty awesome downside potential, at least from 20% of the portfolio. And now when it comes to the income right here, now in addition to coupons and variable return, if any, the ELN manager can also generate income by selling covered calls on the underlying securities. So this portion is just like QYLD and NUSI, selling covered calls to generate extra premiums that are paid out as dividends. And finally, this bit right here kind of summarizes it. More specifically, 20% of JEPI's capital is invested in securities that will produce ongoing income throughout their lifespans, will not go down, and may even produce a variable return. So both NUSI and JEPI have super high dividend yields that are almost identical right now. They both offer downside potential, but JEPI is definitely taking a more complicated strategy, which may not be great long term, only time will tell. But the secret weapon of JEPI is that 80% of this ETF is just regular large cap dividend paying companies. So that's not going to limit upside potential nearly in the same way as an NUSI. Because after all, the major selling point of NUSI is that it's bound between a range of 10 to 15% up and down in a single month. Now, a quick step back, depending on who you are as an investor, either NUSI or JEPI is going to sound really good right now. So it fully depends on what your risk tolerance is and what you really want in your financial vehicles. If we come back and take a look at the price performance of JEPI and NUSI right here in the past year, and we add in the general market, the SP 500, we can see that both lag the market. Although the goal of JEPI is to, in the long term, have most of the returns of the general market. So it should be close to the SP 500 over a long period of time. And NUSI, of course, is focusing on just never having large dips. So it protects you with that put option, but it also limits your upside. So hopefully this video helped you a little bit in your research. I'm thinking my next video is going to be a very big comparison between all of the income producing ETFs. So subscribe to the channel and leave a like if you guys want to see that. But until then, I'll see you next time.